Hello, everyone. My name is Ian Bailey. I'm a reporter with the Globe and Mail's Ottawa Bureau, and I'd like to welcome all of you to today's event. Before we begin, I'd like to acknowledge that the Globe and Mail's Ottawa Bureau is located on the unceded territory of the Anishinaabe Algonquin Nation. My colleagues and I are grateful for the opportunity to live and work on this land. Let's talk about the topic at hand today, how to prepare a business for sale. Selling a business is a significant decision. It involves careful planning and consideration. With the right approach, it can lead to a rewarding transition, whether for personal goals, financial security, new opportunities. So during the last 10 minutes of this panel, we'll be wanting to hear from you. We'll be answering audience questions. If you have any questions for our panelists, please type them in the virtual Q&A box. On behalf of the Globe and Mail, I'd like to recognize Doan Grant Thornton for supporting today's event. Now, let's introduce our panelists. Today, we have Tracy McVicker, a partner at CAI Capital Partners. We have Troy McDonald, a partner at Doan Grant Thornton. We have Sarah Wilcox, the co-founder of Genuine Tea. And we have Kim Lee, partner at Stikeman Elliott LLP. Welcome to everyone. Thanks for joining me today. For everyone, can each of you tell us about yourself as it relates to today's topic? Whoever wants to go first. Troy, why don't you start?
Sounds great. So yeah, my name is Troy McDonald. I'm a partner with Doan Grant Thornton in our Toronto office. I've been working in mid-market mergers and acquisitions for about 30 years. I've been with the firm for about 21 years, and we would help our clients look at acquisitions, divestitures, and mergers as they're looking to realize the value in their business or create value. So thanks, Ian. Appreciate being here.
Sarah, would you like to go?
Sure. My name's Sarah Wilcox. I'm the co-founder and CEO at Genuine Tea. We're a leading omni-channel tea brand offering ethically sourced teas from around the world. Recently, we closed a transaction where we sold 81% of our business to Good Food Market. So I'm really happy to be here today to share my experience and offer some insight from the seller's perspective. So thanks for having me.
Kim, what about you?
My name is Kim Lee. I'm a partner here in the corporate group of Stikeman Elliott in Toronto. I'm the co-head of our private equity and private M&A group. Regularly act for sellers in the sale of their businesses, doing everything from helping them set up their businesses for sale, helping them with the due diligence process, negotiating LOIs, negotiating the purchase agreements and the purchase structures. And getting them to a closing. We also regularly act for buyers, so we sort of see both sides of the coin, which can be really helpful in these processes. Happy to be here today. Thanks, Ian.
Thank you very much. And Tracy, why don't you wrap us up?
Sure. Thanks a lot, Ian. I'm Tracy McVicker. I'm a partner at CAI Capital Partners in Vancouver. We deal almost exclusively with founders of mid-sized businesses, anywhere from kind of 3 million to upwards of 15 to 20 million in cash flow, and Canadian and US, and over 20 plus years with the firm. Feel like I've seen maybe not all of it, but I've seen lots. So I'm very happy to be here today.
Thank you, Tracy, and thank you to you all. Troy, let's start with you. What trends are you seeing in mergers and acquisitions?
Yeah, Ian, thanks for that. I would say volatility is the key word. Coming out of the pandemic or through the pandemic, we saw a surge in M&A activity. Valuations were strong, due diligence was light, financing terms were lighter. Then as we came through 23 and interest rates started to climb, inflation started to climb, we saw that transactions got more difficult. There was more structuring, more due diligence, and valuations tightened. Now, as we come through the back half of 24 and we can see that the interest rate environment is changing, what we're seeing now is a lot more clients are looking to bring their businesses to market. Transactions are starting to move at a quicker pace. The valuations are strengthening. So you can tell there's a bit of optimism coming back into the market, but it's definitely been a very volatile time, Ian.
There's also been a U.S. election. Tracy, what are the opportunities and threats for business owners looking to sell their businesses as a result of that election south of the border?
Sure. And maybe I'll clarify that question a little bit. I think what we wanted to ask is more what are the implications of the election results maybe for Canadian business owners who are thinking about selling. And
Sure.
because we see businesses on both sides of the border, and we actively own businesses on both sides, I'd say there are both threats and opportunities. I think we've had a lot of discussion in the press about threat of tariffs. I think we've already had experience under a Trump administration with tariffs. It was quite narrow in scope, but it impacted, a lot of dollars. We don't know how that is going to play out. I think if you can have a foot in both camps, it's extremely it's a very good hedge. I think if I were asked my view on USD, I would say I would like to be in US dollar. I would sure like to be in a business that's receiving US dollars into maybe a Canadian expense line. So if you're building in Canada, let's hope we don't get impacted by tariffs, and receiving US dollars, I think that's going to be very, very favorable. The business climate in the US is very friendly, and we really see the difference. So, if there was ever a time to take your business into the US, I think there's a lot of demand. There's still a huge infrastructure deficit. There's still a very powerful Inflation Reduction Act. And, he might even bring back the bonus depreciation. So basically in the first Trump administration, he made a very favorable way for you to fund capital expenditures into US businesses. And he made it very attractive to buy equipment and make investments. So let's see if he does that again this time around.
Thank you very much. Sarah, let's turn to you for a moment. Who are the different types of buyers, and how did you personally go about deciding what type of business you want to sell your company to?
Yeah, I think selling your business is a very big personal decision. And I think it really requires a clear understanding of your personal goals and what you're trying to achieve. But not only that, there's two people involved in the equation. It's a lot like dating. You really need to be able to see it from the buyer's perspective as well, and clearly understand what they're trying to achieve so that you can better position your business to have a successful outcome. In terms of the types of buyers, there are financial buyers like large institutional investors, private equity firms that are looking to acquire companies to generate a return. Then there's your individual buyer who's maybe trying to purchase a business and operate it themselves as a source of income. And then there's the strategic buyer, who is potentially a larger company who's looking to acquire a business that can add some kind of synergistic value to their already existing organization or portfolio. For us, from day one, we were very clear. We weren't looking for a full exit. We were really looking for that strategic partner to help us take what we had already built and scale it to the next level. So Good Food for us was a natural fit. Not only did they have a lot of expertise in the e-commerce space, D2C marketing, their food and beverage innovation, as well as their infrastructure and distribution capabilities. But not only that, they were looking for founder-led businesses. They wanted the founders to retain equity and keep leading the business into the next phase of growth. So for us, I think it worked out really well because our goals were so aligned on both sides. So I think it was a clear decision for us.
I'd like to ask everyone about what businesses can do to best prepare themselves for sale. And perhaps, Sarah, you can start, given that you've been through this experience.
Yeah, I think obviously your finances are a very important part of your business, especially in today's economy. You need to show that your business is growing, but also that it's profitable, at least for a business of our size. You're not talking revenue multiples, you're talking EBITDA multiples. So being able to show that growth and profitability at the same time, I think is really important. Also having strong brand value. And in our case, I think something that really made our business attractive was how diversified our business model was, not only across our customer base, but also across multiple sales channels. So I think a lot of founders, especially in the CPG space, they get sort of like narrow-minded and focus only on one channel. And I think if you can kind of get creative and find new avenues to sell your business or product to, you're really sort of strengthening your business as a whole and making it a lot more attractive to a potential buyer.
Okay, does anyone else want to answer that question about what businesses can do best to prepare themselves for sale? Is Sarah? I'm sorry, Sarah, you've gone. Sorry, Troy, why don't you pick up, Troy?
Yeah, I'd echo Sarah's comments, but I was add two other concepts to that. It would be dealing with dependence. And what I mean by dependence is, for example, if you're overly dependent on a particular supplier, if you're overly dependent on a particular customer, or maybe overly dependent on one or two key employees, often that might be the owner and founder of the business. You really want to make sure you try to manage those risks so that when you do go to market, you've been able to demonstrate that you've dealt with that dependency issue and your business has the flexibility to adapt should anything happen to any of those key relationships. So that's another point I'd add.
Tracy, what do you think?
Yeah, I think that Troy makes a really, really good point. One of the hallmarks of a thriving founder-owned business is sometimes one big customer, and reducing the dependence on one big customer, because it just introduces like kind of what we call stroke of the pen risk, or a level of risk that some buyers find it very hard to digest. So I think that's really, really important. I'd also say reduce, and I think Troy kind of started this with this point, but really try to reduce the dependence on the founder. Quite often we see businesses, and again, they're successful, long-standing, couple decades old, and the founder has really put their whole life into building the business, but so much is in his or her head that it's very hard to separate the founder from the business. And that's really what's going to maximize value, is if there are operating procedures that are documented, if there are people besides the founder that are familiar with the customer base, that understand the supplier base. And if you broaden out the footprint of the founder's brain really as much as you can before going to market is probably a really good idea.
How do you go about doing that? How do you go about separating the founder from that process? I mean, is it challenging?
Yeah, like often the founder, as an example, is the chief of sales, the head of sales and chief revenue officer, and without maybe carrying that title or even being aware. But quite often it starts with bringing in one or two people who might, or elevating one or two people and actually stepping back while you're in the chair to allow them to learn the business and learn the relationships, and kind of build their own relationships separate from the founder.
And Kim, your thoughts on this subject?
Yeah. So I mean, I think I echo everyone's thoughts. I mean, all of a part of preparing a business for sale is identifying what are the key weaknesses, vulnerabilities, and that sort of thing that you might want to resolve that would raise flags for the buyer, and that would make the buyer sort of question the business or create issues and things that you have to negotiate around. So certainly, I think taking the time to prepare and identify whatever issues are out there. So, for example, where are your minute books? Do you have minute books? Have they been maintained? Are all of your employees subject to employment agreements? Are they valid? Are your customer contracts accessible? Have they been renewed properly? Is your lease up for renewal in a very short period of time? All of these things, if you can get ahead of them early enough, will just create a lot more of a streamlined process for diligence when it comes to starting to negotiate with the buyer down the road.
Excellent. I think we've dealt with some of the aspects of this, but I'm curious if anyone has any comment on what vulnerabilities within your own businesses should you identify prior to putting the business up for sale. Does anyone have any thoughts on that subject?
I do.
Tracy, go for it.
I think maybe Kim can help me a little bit with this, but introduce the concept of representations and warranties. So when you transact, you are going to make a series of what we call reps and warranties, and you are going to kind of give some insurance to the buyer that things that happened in the past that come back to bite the company are on, I would say, the founder's account versus the buyer's account. So those are things like tax issues. So, big tax reassessment from 7 years ago, that's going to hit the seller, not the buyer. So there are other things like harassment claims or, employment issues that arose before the closing of a transaction. Those are really important to at least be aware of what kind of risks might come. You can actually buy insurance for reps and warranties now, and that's pretty common and relatively low cost way to mitigate some of those. But if you have an idea of what might come at you, you have an idea if you need to buy that insurance. And then I'd also say you might need consent for a change of control that you are unaware of at present. So it's possible, if you read your lease, that your landlord has a consent right because they're getting a new owner of the business and a new payer. You might have break fees on the mortgage on your property, on other debt that you carry, and usually the buyer wants to pay out your debt and bring their own. So I'll stop there, but those are the kind of
Excellent. Very thought-provoking.
that,
Troy, is there anything you would add
I
to
was
that?
thinking of.
I'm sorry?
No, yes, maybe just a couple things to add. I think those are all great points. And, maybe another point we'd say is look at your contractual inventory and understand the contracts you've committed to. Often what will happen is those be critical documents, whether they're supplier contracts, customer contracts, key employment contracts. And you want to make sure firstly that you've got them all organized and ready and you understand what's in them. And, I'd echo some of Tracy's comments around that. We've seen lots of situations where there's conflicting provisions in those contracts. And what you want to be able to do is deal with that up front and get ahead of it and make sure you've addressed it. We had one transaction we worked on years ago where the owner had actually given out multiple rights of first refusal to different parties. So we actually had to spend time up front dealing with that to make sure we had dealt with it. In a similar vein, often one thing we'll do a lot now is we call it sell-side due diligence. And so we'll actually have our due diligence team look at the financial information of the company, the commercial information of the company, and review all of that before we even take the company to market. And through that, we can actually spot issues and have time to deal with it. And then when it comes time to actually running through a sales process, we're able to actually share that information with the buyers and have them bid with that due diligence already done. And, I think when we were discussing it before, we talked about it. It's almost like getting a home inspection done on your house before you sell it. And we find that that's an increasingly common trend and one that often creates a lot of values for our clients because it really helps in the latter stages of a process and to get ahead of issues.
Troy, what kind of challenges does a company face that doesn't identify these vulnerabilities that proceeds without doing this work?
Yeah, a classic example of it, often we'll go through a sales process and we'll move to what's called exclusivity when we finally narrowed it down to one buyer, and then we're committing to work exclusively with that party to complete a transaction. If they're just starting to do their financial due diligence or commercial due diligence at that point in time, any issues they discover, they will most likely use to try to reduce the purchase price or improve the terms to be in their favor. And so what we like to do is try to get ahead of those issues, negotiate with them when we have competitive tension and multiple bidders at the table. And that way, when we do finally go exclusive, we're able to actually have already addressed those issues. And it's more difficult for the acquirer at that time to try and use them as a reason to reduce the price because we dealt with it before we went exclusive. So that's one of the reasons why I think it's quite important.
Sarah, do you have any thoughts on this, given that you've gone through the experience?
Yeah, absolutely. I think one lesson we learned pretty early on is the importance of your balance sheet. I think that when you're running your business, especially, businesses of our size, we're so focused on the P&L, running the day-to-day. I think having a regular review of your balance sheet is really, really important, because when you get to due diligence and they're drilling down onto each line item, you need to make sure that there are no issues there. So if you can flag that ahead of time and resolve anything that's been going on, you'll be in a better position. You know, a small little bookkeeping error that's sort of going on for a long period of time can really snowball and make a big impact on the balance sheet and P&L. So I would just recommend to take a look at that, work with your accountant to make sure that that's not being missed during your financial reporting.
Kim, before we move on, Kim, do you have any thoughts on these matters?
Yeah, absolutely. So, and appreciate the reference to rep and warranty insurance, Tracy. It's obviously one of our favorite topics, and certainly a really great way for sellers to protect themselves in these processes. I mean, I think as we were talking about the initial on the initial questions, you know, preparation is so key on these things, and really fundamental to get a really good understanding of your business. Doing sell side due diligence is the best way to flush out all these issues in advance of kind of negotiating and interacting with the buyer, so that they're not catching you flat-footed. And so you lose leverage and kind of dealing with these things on the fly, and you have a well-prepared response or way to address these issues. These things will also come up, you know, in the process of how you determine how to indemnify for these things, right? So if there's some sort of outstanding litigation, or if there's a loss of a major customer, or some other, you know, dispute with an employee, those sorts of things, those things will come up as, well, how do you indemnify for those, right? And that's going to become part of the negotiation. For all of the unknowns in the business, though, stuff that you can't possibly have prepared for. So, you know, let's say there was a leak in the groundwater that no one knew about, and they won't know about until after closing. How do you protect against these unknowns, and then also allow a seller to sleep at night and know that they're sort of done with this transaction once they've closed the deal and can sort of walk away with their money in their pocket? Rep and warranty insurance is often the answer, or at least helpful for that. And what that is it's a insurance policy that typically a buyer will take out, and that will give the buyer insurance on any breaches of the reps and warranties that the parties don't know about. So it protects them for all the unknowns that the seller couldn't possibly have prepared for or anticipated, but allows the seller to sort of sleep at night in terms of not taking on the indemnity for those things themselves, but allows the purchaser another recourse, an insurance company and a policy to claim under if those things arise.
Thank you, Kim. Troy, what kind of improvements can business owners make to their company relatively quickly?
Yeah, for sure. Maybe I'll cover a few themes there. At first, I'd say look at it through the lens of the buyer and think about your business that way. One example we would share is get your financial reporting working well, and start to make sure you really understand the trends in your numbers. Look at things that are maybe fluctuating in a less positive way, and try to understand them first, and then develop strategies to address them. Another important thing is to actually start forecasting. So projecting your financial results. Often in every transaction, it's a forward-based activity. The acquirer is not looking to really buy your history. They want to buy the future. So being able to accurately forecast your numbers and be able to present that will help drive a better valuation and provide better information throughout the process, and ultimately, I think, improve the outcomes in the transaction. You know, one interesting example we were dealing with a client, and we were helping them take their company to market, and we were planning ahead of time. Through that journey, we started to agree with the client and identify that there was a certain market and certain products that weren't part of the business today that would really help improve the business and diversify it and demonstrate the ability to grow it and scale it. And so we actually helped our client acquire a small competitor in that targeted market that was selling these specific products. And through that acquisition, they were able to acquire the company, really strengthen the value proposition of the business at large. And, you know, one of the really interesting aspects of that is, you know, they were able to acquire the business at about a 5 times EBITDA multiple, and that business was transacting at something higher. So they actually immediately created value for themselves because they brought that smaller business and brought it into a larger company that attracted a stronger valuation, which has really helped with the eventual sale of that business. So just sort of an example of some of the things you can do to improve a business, and the importance of getting ahead of it and looking at it through the lens of a buyer.
You mentioned the notion of wanting to buy the future. It's a very interesting notion that sums up this process. Kim, you talked, I guess, off camera, so to speak, about time being a deal killer. Can you tell us more about what this means and how to avoid it?
Yeah, absolutely. I mean, the law, I think it's Parkinson's law where work expands to fill the time. So, the more time you give a buyer and their counsel and their advisors time to sort of dig into issues, worry about them, stress about them, discuss them internally, and kick them around, the more those issues begin to balloon out of control, right? And you sort of start to lose control of that process. So the more tight you can kind of maintain your timeline from signing or negotiating an LOI to the closing of a deal, the better. And a lot of that is going to be, again, as we talked about at the outset, preparation. So understanding what consents are going to be required from your customers, from your landlords. If you need to repay debt, if you have a credit facility open, what's going to be required in order to pay that off? Are there any additional fees? Do you have to sort of loop in the bank early? Is your father on the payroll? Is your cottage or your personal vehicle under the name of the company? What do you need to do to get the title changed? I mean, the last thing you want is, at closing, on the eve of closing, for you to be at Service Ontario trying to get, your license changed for your car, those sorts of things. So anticipating what the conditions are going to be to the sale and what the buyer is going to require in order to close the deal, that's going to give you the best sense of deal certainty, and also allow you to expedite the deal as quickly as possible, and allow that interim period between kind of negotiating the LOI or signing exclusivity to closing to be as short as possible.
Thank you. Question for everyone. We're talking about advisors. How do you go about finding an advisor? What questions should you be asking them? Sarah, perhaps you've been through this experience. What would you advise on that?
I mean, I can't stress enough the importance of having a good advisor and having someone in your corner, especially if you're new to M&A and you've never been through this process before. They know what to look for, how to negotiate you the best possible deal. I would say getting a referral is probably the number one thing you can do. We had a really incredible experience with our advisor team over at IJW. Like, I can't stress enough the value that they brought to our transaction. I think also having a good personal fit is really important. This process is very intensive, and you end up spending hours and hours with these people, really getting to know them and sort of going through something that's ultimately really, really personal. Dave, my partner, and I used to joke that, they weren't just our advisor, they were also our therapist throughout this whole experience. So I can't stress enough the importance of finding a good advisor.
Oh, excellent. Sarah, I'm sorry, we've done you, Sarah. Troy, what would you suggest about finding an advisor?
Yeah, I'd echo Sarah's comments, and I think I'd probably emphasize the fit. Like, I think making sure it's a very good personal fit. I think Sarah's comments are bang on in terms of what that journey is like and how closely you're working together. I think some other things to look at as well would be industry experience. So that's one thing we find is very important, because you're able to really, as an advisor, know who the fits are in the industry, understand what market is in terms of terms and value. So that can be very important. I also think it's having somebody with a good track record of success. So someone who clearly can demonstrate that they know how to get transactions across the finish line. And then finally, a very reputable brand, because I think one of the things you're looking for your advisor to do is to bring their brand to bear, to help add additional credibility to the business, and to really be able to open doors with strong potential acquirers. So I think those are some of the other things I'd encourage people to think about when they're looking to pick an advisor.
Kim, what would you suggest about looking for an advisor?
Yeah, I mean, I echo all of Troy and Sarah's great points. I always say, if you want to hire an expensive lawyer, hire a bad one. So I think it's always really, really important to do your market checks on whoever it is that you're about to hire. You're about to, walk down the most important road of your life, right? You're selling your business. It's something that you've spent a significant portion of your life building. And use the reference checks, right? Any advisor, financial, accounting, lawyer would be happy to provide you with the names of, people that you can call, and will share with you their experiences. And if it's something that, if it's an experience like Sarah had, where, they were her therapist and also so helpful with the deal, that's someone you want in your corner, right? Someone who's practical and has deal experience and won't hold things up just, for the sake of winning a point. At the end of the day, we're all here to get a deal done, and a transaction done, and the advisors shouldn't get in the way of that, right? Like, they should be on the side of their client and whoever it is that they're fighting for, but they shouldn't be trying to hold the deal up just to sort of win the principal point.
And Tracy, what do you think?
I think those are all great points. I think there are a few things that you need to ask a prospective advisor. So let's say once you've got references and lots of had a bunch of conversations and really narrowed it down to maybe one or two, I think it's really important to understand how they market your business. There are some advisors, and so we see probably 450 to 500 deals a year from 80 different agents. So we have a lot of traffic in information about companies. And I'm not sure the founders always realize that in some cases their pretty sensitive information is going out to thousands of email addresses that may or may not be legit, qualified buyers. Surely if it's going to thousands, these aren't qualified buyers. They might be your competitors. They might be, and there's tiers of information that go out before, you don't get super detailed information unless you sign a non-disclosure agreement, but nonetheless, competitors find out that you are on the market. That's important information. And I've seen it weaponized against a company, for recruiting purposes, for customer, stealing customers. You don't know who's going to own this company. They're for sale. Did you know that? I think so. What you want to ask your agent, there are some that are very broad and there are some that are very narrow and targeted. And this speaks to specialization and knowing the industry and a rifle shot versus a shotgun. So I think that's something that a lot of founders don't realize that they really want to ask about.
And
Excellent.
maybe, Ian, if I could add
Troy,
to that.
of course,
I
Troy, go.
think, Trace, that's a fantastic point. And one of the things we do is we actually take a lot of time having a very targeted process where we look at who are the potential acquirers, are they credible parties, would they have, what is the reason they would do it, and then focus on those parties that are most likely to transact as opposed to going too broad. Because I'd echo your comment about those risks. And then what we try to make sure we do as well is we use a number of protocols to protect confidentiality. So upfront, getting parties under a non-confidentiality agreement before they really know anything. And then sharing the information in a staged manner. So a confidential information memorandum that's designed to get the information needed to get an initial indication of interest, but not give away confidential customer or employee information. Save that for later in the process when you've really narrowed the field down to those most preferred buyers. So I just think that's a great point you've raised and just wanted to echo a few thoughts on it.
Thanks, Troy, and thanks to everyone on this issue. I'd like to move into another area, and that is what you can do to increase deal certainty. And Troy, you're there. Let's start with you on that. What do you think you can do to increase deal certainty?
Yeah, for sure. A few things. We've talked about sell-side diligence, but maybe just to add to that. So when we undertake a process to sell a business, we will run a formal structured process most often. And what that does is it allows the buyer to really take control of the timeline, who's involved, and how quickly this is going to come together and what needs to be determined beforehand. And so through that process, we'll narrow the playing field down to the bidders who are most likely to transact at a strong value. We'll have had multiple rounds of discussions and bidding with them to drive up the price to the best possible number, as well as get the best possible outcomes and terms and things of that nature. But in addition to the sell-side diligence, before you go exclusive, I'd also add having a very detailed letter of intent. And that letter of intent should really capture all of the key legal terms. I'm sure Kim will be able to add to this. Because what we often find is you might take what appears to be the strongest bid, but then you go exclusive and you find their legal terms that they would be looking for are quite punishing and possibly off market. So that's a point that we find is really important to really help go before you go exclusive, get as close as possible to the finish line and deal with the tough issues up front, not afterwards.
Excellent point. Does anyone else want to build on that issue, or answer that question about increasing deal certainty?
Yeah, for sure. I mean, Troy, I absolutely agree with that. I mean, I think that the more, what I often see in sale processes, we'll often have an auction draft of the purchase agreement already provided to buyers, and that'll be part of the submission of their bid, right? So they'll come in and not only sort of give you the price that they think the business is worth, and that's one of the factors that you compare against, but also provide a markup of the purchase agreement with their anticipated terms. And so that gives you a snapshot immediately of what they anticipate in terms of what types of liabilities you're expected to offer up, what sort of conditions to closing that they're expecting. So are they going to try to make it conditional on obtaining their financing, right, in order to do the deal? Are there certain employees that they want you to have sign up to new employment agreements before they agree to do the deal? Are there key customer consents that they're going to insist on that are required under the contracts? Are there certain pieces of indebtedness that they're going to want to come off the business? Or alternatively, is there, bank accounts and things like that they want to have transferred to the business? All of these things can take quite a bit of time and legwork to complete, and really go to deal certainty in terms of how can you achieve all of these things in that period of time between when you go exclusive with a buyer and when you close. And so the more you can minimize the number of those conditions, the better. But having eyes open to those upfront in terms of when you negotiate your LOI, when you receive markups of the auction draft of whatever purchase agreement you issue, those are all helpful in kind of determining exactly what it is you're going to need and have a real roadmap to closing the deal.
Thank you, Kim. Tracy and Sarah, what do you think?
I might add to that a point about financing. So you sure want to make sure that once you pick a partner, that they have the money. Quite often the banks will commit, like pre-commit financing. Sometimes the seller even comes with, we call it like a stapled finance or a deal that has already got pre-approved bank financing for the acquisition. So at least the bidders have a sense of where the banks would be. I mean, banks lend on cash flow for sure, but they lend varying amounts, and it depends on lots of factors. So I think absolutely having committed financing or a very clear sense that this buyer doesn't have to go and raise money to complete the transaction is really, really important.
Excellent. Sarah, let's finish with you. What do you think on this issue of increasing deal certainty?
Yeah, I think those were all really great points. I think one thing that I could add to that is from a founder's perspective, when you get an LOI from a buyer and you've provided them with targets, they're expecting that you're going to hit those. So this process of selling your business, it's incredible how much time it takes actually away from the running of your actual business. So just to remind people to not lose sight of that goal as well, and actually continue to run the business and grow it as if this process wasn't even happening. I think the worst thing you can do is focus fully on the deal and let your business kind of fall to the wayside, because these processes can drag out, 6, 9, 12 months, I'm sure in some cases even longer. So you want to make sure that throughout that process, you're keeping that buyer excited about the opportunity and that you can maintain your negotiating position by actually showing that you're able to grow and continue to grow your business.
Was that a challenge for you and your team to sort of maintain the business and proceed with the process?
Yeah, I think we managed it. I also have 2 young kids at home, so it was a lot. But I think having a really good team and really good systems in place as well really help manage it all, as well as that advisor team. Again, they just kind of keep the process moving, keep you on track, keep you accountable. And one thing, I think throughout this process is you really learn so much about your business and can kind of identify issues and challenges that maybe you wouldn't have fixed if you were just continuing to run the day-to-day. So I think ultimately in our case, our business is stronger today than it was when we started the process.
Excellent. Kim and Troy, I'd like to explore another area, namely the red flags to look out for from a potential buyer. Kim, perhaps you can start.
Yeah, absolutely. So I think as you're going down the process with your buyer, one of the things, and similar to what we talked about at the advisor stage, is really getting to know the buyer and selecting the right one and having the right fit. So one of those things is going to be checking on the background of the buyer. Have they done sort of similar deals in that same market, in that same industry? Are Are they deal savvy? Do they have lots of deal experience? Are there other founders and entrepreneurs that they've acquired businesses from that you can speak to and do a little bit of due diligence on your end about, whether or not they're the sort of folks who will sign an LOI and commit to it, or whether they're the sort of folks who will sign an LOI and try to trade on, a couple of the items that you would sort of agree to or had discussed. So doing a bit of the background diligence on the purchaser in that way is good sense. The other things is just trying to keep a very close line of communication with the buyer throughout the process and checking in constantly about where they're at. So are they done with their due diligence? Have they sort of conducted it to their satisfaction? Are you going to still expect a dozen other questions once you think you've satisfied them? Where is their rep and warranty process at? I know Troy's going to speak about financing, so I'll leave that to him. But in terms of just keeping those avenues of discussion open, are we settled on the purchase agreement? Are we settled on the employment agreements? Are there any open topics? Having that line of communication be constant and open so that you're well aware of how the process is operating is going to be really important for you.
How do you manage that line of communication, keeping it natural without being onerous? Any suggestions on the right tone to strike in that process?
It is onerous. I mean, you can't help it when you're doing a transaction. It often tends to be the closer you get to closing, you end up talking almost every day, and it's quite natural. There's going to be constant check-ins on, all right, I have a question on diligence. Let's talk through integration planning. Let's chat about how employee communications, things like that. So you're going to almost have daily calls, even if you don't set them up in a sort of strict and scheduled way.
Excellent. Troy, your thoughts on the red flags to look out for a potential buyer?
Yeah, absolutely. I mean, I'd echo Kim's comments, maybe just to add a few other ideas. Financing is something to watch out for. So the buyer should be able to clearly articulate how they're going to finance the business. They should be able to demonstrate that they've got that financing well advanced. So for example, a discussion paper from a bank might be an example that they've got the debt component of it lined up. I think you also want to watch out for, are they spending too much time focusing on the financing the seller is going to provide? So one thing you can see sometimes is that they're actually trying to use the seller's business to finance the entire purchase and not put much of their own money in. So they might have debt they're looking to put on the company. They're probably trying to negotiate a particularly large vendor take back or earnout. And so those are warning signs that they actually may not have the money to complete the transaction on their own. And then another indication we find is, do they have a team with them? Do they have advisors that they're involving? If they're being hesitant to involve their advisors or their lawyers or other parties, it might be an indication that they're not fully committed to the transaction because they're not willing to invest costs that are commonly incurred. Are they doing due diligence with an advisor and bringing that about in a professional manner? So those are some of the things we would suggest you watch out for to make sure you've got a buyer who's serious and capable of concluding a transaction.
Excellent. Sarah,
maybe
sorry,
I'll add, can I add one more?
Of course, absolutely.
One more thing, Ian, because I think we have time.
Yes.
I think the highest price, let's have a discussion about the highest price and where that comes from sometimes. A very high headline price is coming as a result of a very favorable debt financing package. What happens to a founder who stays around like Sarah and rolls, maybe continues to be an equity holder, you wake up the day after the deal in a very different place, with obligations, sometimes crushing obligations to the bank that you never had before. And Sarah, I know you were more of a high growth CPG type of business, so this probably didn't apply to you, but we see lots of industrial businesses. And what some founders might not realize is the path to that big headline price for your business was a very challenging balance sheet the next day. And it impacts, those payments impact how you can fund the continued growth of your business. And until you are able to chip away at some of that debt, and even in a even worse case that I actually saw in the last month, your cash flow is funding a different division's acquisition. So either, stripping your cash away from you and away from your growth opportunities to pay for some other deal they did. So I think you want to be really careful about the headline price and again, like, look at where the money's coming from, because your life is, unless you're selling 100% of your business, which we can also talk about, your life will be really impacted potentially.
Yeah, and Ian, would it be okay if I add just to that? Because I
Absolutely.
it's such a great comment. The other thing we find, we always say the devil's in the details. So to echo Tracy's comment, you may have a strong headline number, but as you peel back into it, you start to find out it's got very unfavorable expectations around working capital, or maybe it's got excessive expectations around a vendor take back where the seller is going to finance part of the purchase. You might find that the legal terms are actually quite punishing, or the expectations of the vendor are off market. So really need to understand the full deal to really figure out what's your best option.
Sarah, we're going to, before we move into questions, Sarah, I want to ask you about, I'm sure you learned lessons during the process of selling your business. Is there any advice you'd like to share with other business owners who may be going down the path you went down?
Yeah, I would just say, be prepared that this is a very intense process, comes with all range of emotions. And I would also just say, timing is really, really important. Sort of knowing when to take your business to market, I think, is key. When the going is good is probably a good time to look for that investment. Don't wait. I also think that it's not all about the money, at least from my perspective. Being able to build something and then sell it is such an incredible feeling, and it's like the ultimate graduation. I think it's what all business owners are striving for. And if you can achieve that, it's a really wonderful thing. It also really validates what you've been spending your time and your effort on. So just to keep that in mind as well. It's also about, personal growth, expanding your network, and ultimately protecting the future of that business that you've worked so hard to create.
Excellent. We have been collecting questions from our virtual audience, and we'd like to take some time to answer or to put some of these questions to our panelists today. So let's pick some of them out. I'll start. Here's a question from one of the member of the audience. Can your panel discuss various financial statement requirements that the seller should consider in preparation for the exit? How far in advance should you be seeking an advisor before putting your business up for sale? If anyone wants to take that question.
I'm happy to share a couple thoughts. Firstly, I think for whether it's your financial advisor, your legal counsel, involve them early, because that lets you start to get advice on how to make sure the business is best positioned. So I think the earlier you can start the discussion, the better. A lot of times we'll talk about the first stage is actually how do you build the value of the business before you even take it to market. So we find that's important. And in terms of financial information and how to get ready, if I followed the question correctly, a few thoughts I'd share is, start to make sure you have external accountant prepared statements, so reviewed or audited, so you've got that discipline into the business. Make sure that you've got your financial policies and things like that documented, that you've got capability in your accounting group to produce accurate, meaningful, timely information. Also, the forecasting point we talked about before, start to turn that discipline into the business where you can forecast accurately and then reconcile actuals to forecasts. I think that becomes very important. And then I think really understanding your financial information. So understand the key trends, the key metrics, things like gross profit, EBITDA percentage, your net working capital, the amount of leverage you have in the business, revenue growth. And today you can go even much further. There's lots of tools like Tableau that you can use to analyze your business and using data analytics to better understand what's really going on. So I think the more you can get ahead of that and start to know your numbers inside and out, that's a great place to be.
Tracy or Kim, Sarah, does anyone else want to address that question?
I think there was a secondary question that you said about how far in advance should you be seeking an advisor before putting your business up for sale.
Yes.
As far as you can. I think the time from when maybe the thought creeps into your mind, like I might want to do something different, to getting a deal done is probably a couple of years. If done properly, and if you take the time to, get the business running for 3 or 4 quarters in the way that you want it to be viewed. And that takes a lot of, could be more. So I'd say it's not never too early to start thinking about it, but when you start thinking about it, you should, take some action, because it'll take longer than you think to really optimize.
Kim, do you have any thoughts on it?
Yeah, I completely agree with all of that. I mean, I think, again, all the things that we've been talking about in terms of preparation, that takes a lot of time. And frankly, for the majority of founders, this is going to be the first business that you've ever sold. So there's tons of learning down the road. And it's also a staggering amount of work to do. An M&A process is not a straightforward, simple thing. You've got to sort of expose the entirety of the business to a buyer. So you've got to dig up all the contracts that you have, all the minute books that you have, every single lien or piece of litigation or dispute claim, all of those things. I mean, that takes a lot of time and effort. And in the meantime, you're also trying to run a profitable business, right? So juggling all of these things means the more time you give yourself and the more runway you give yourself to do all of the tasks that are required to get your business set up for sale, the better.
Kim, there's a specific question here for one of the for you. I'm sorry, for one of the viewers. They say Kim mentioned personal use assets and corporations. Should we be checking to ensure asset levels in corporations will result in qualification for QSBD, qualified small business corporation, for each of the shareholders?
Yeah, so that's a great question. I mean, I think that has to do with the lifetime capital gains exemption and wanting to be able to access that. So yes, I mean, the shareholders of that business should track very carefully that, which assets are strictly business assets versus which assets are going to be personal assets. And I can tell you from a buyer's perspective, the buyer's not going to want to see that your cottage, your jet ski, all of these things, that might have been acquired by, because these things get very muddled, right? When you're a founder, the line between personal and business gets quite blurred. And so it is quite important to make sure that you distinguish between the two for that tax reason, but also for the fact that, a buyer is not going to want to acquire a business with all of these personal assets in it.
Excellent. Does anyone else have any thoughts on that issue? No, okay, I'll move on. There's an interesting question here, and I don't think we've dealt with it, and that is whether you can provide a range on how long it takes to sell a business.
I'm happy to share a few thoughts on that.
Sure.
And I think it probably depends on when you're starting the clock on that, because I'll probably say that pre-process process can be quite long in terms of how do you build value in the business. But once you start the process, we would normally say that's a 6 to 9 month journey. And what that involves is the actual preparation stage in terms of putting together the documentation for the confidential information memorandum and all those, identifying the targets and refining that list. And then you go to market and you run usually 1 or 2 rounds of bidding, and you're negotiating with the parties through the journey. And then you look to go exclusive with that preferred party once you've optimized your deal certainty and moved to the finish line. So 6 to 9 months is sort of the normal answer. I would say during that softer period we had in the back part of 23 and early 24 with the interest rate spikes, that got stretched out. So there was a number of transactions that we were involved with that were actually starting to take over a year because the level of due diligence requirements, the financing process, the negotiations all became a lot tougher. But as a general rule of thumb, we'll say 6 to 9 months.
Interesting. Anyone else have any thoughts on that subject? No. Okay, we'll move on. There's an interesting question here about how do you deal with an offer from a close competitor in terms of mitigating the risk of presenting your business's confidential information?
I can maybe take a first stab at that question. I think a couple of things. So the strength of the agreement that you sign, which is called a non-disclosure agreement, before giving really any information is really important. It's usually happens after some information is already out there. So the strength of that and the need to really have a good drafter, a good lawyer helping you on that, especially when close competitors are involved, you may elect not to include close competitors in a process at all, and just tell them, it's a hard no. But I think you'd be surprised about what they already know. And so I think you want to balance your opportunity to get a maximized price, if that's your objective, against the fear of disclosing too much. Like, definitely, if you go to the lengths of disclosing a bunch of information and then don't transact for some reason, that's a very tough position to be in, and I've seen that before. It's very, very unfortunate. So I think proceed with caution.
Interesting. Thank you.
I have two other
Of course.
things to add on to Tracy's great
Of course.
thoughts. The first being, what I tend to recommend in those situations where you are allowing competitors into the process and you've signed your NDA is to then stage the disclosure of your confidential information accordingly. So, in the sort of initial stages, maybe you give them a lot of your less significant, less material contracts, customers that are sort of bottom 20 or whatever it might be. And then only as your negotiations progress and you've either signed exclusivity or you get the purchase agreement to a point where you're pretty comfortable that, you're locked and loaded and you have some clear view towards closing, then you start to disclose your really material, very highly sensitive information on, revenues and customers and that sort of thing. The other thing that we often do where we have competitors in a situation is to set up a clean room. So to have only the specific advisors of the competitor be able to access that and relay back their findings in an anonymous way, such that the competitor then doesn't have direct access to your information, and it really has to run through the advisors in a confidential stream.
Thank you. Folks, I think we have time for one more question, and I'll throw this out. From a seller's perspective, are negotiations tougher or easier with private equity buyers? That's a question from one member of our audience. Any thoughts?
I'll share a couple thoughts there. I think the answer is it depends. And so I think what we find is with private equity buyers, they're very obviously good at running or understanding transactions and working professionally and meeting timelines. They're built to get transactions done, and they know how to grow businesses and create value, so they know what's important. So I think that really, really helps. The only area where, and maybe a slightly different point of view, is if you've got a particularly complex industry, sometimes a strategic who's in your space may have a better understanding of the business and might be able to get more comfortable with certain risks that your business has. So that does sort of counter that a little bit. But generally what we would suggest is parties to look at both, depending on what you're trying to achieve, both private equity and strategics, in a very targeted manner, to explore your options.
Thank you.
At the risk of being self-serving,
Go for it, Tracy.
I'm kind of kidding. Yeah. As a PE firm, so I think I alluded to like how many deals we see, and Troy made a really good point. Like, it's our job to transact. So I think what you get at the table is quite a bit of experience, but I'd also say, and motivation to close. But what I'd also say is, if you've met one private equity firm, you've met one private equity firm, and there are literally thousands. If you maybe certainly not in Canada, but in the US, there's upwards of 5,000 PE businesses that are all seeking deals. So I think it's a huge mistake to decide on the basis of maybe one bad interaction that private equity is not welcome at the table. I think that's super dangerous for a deal. But again, your really good agent will have a very good idea of who the serious PE buyers are, who's an expert in your space, and who doesn't retrade, which I think Kim talked about, between one stage of the process and another, and who's generally kind of good to their word. So, you got to lean heavily on your agent to help you weed through all the interests. There are a lot of PE firms that will, we call it like bidding to look, or just throwing in an indication of interest to see if you get a meeting, or to kind of feel out where the price range that they want is. And a really good agent will help you kind of clear all the clutter and get to the right group.
Well, folks, we are at the end of a fascinating discussion. I think a helpful discussion for those who've tuned in today. On behalf of the Globe and Mail, I'd like to thank Tracy, Troy, Sarah, and Kim for joining us today. I'd also like to thank everyone in the audience for attending and sharing your questions. And of course, to Dunn, Grant, and Thornton for supporting today's event. We will be sharing a link to the recorded webcast in about 1 week, and conclude by thanking everyone again, and enjoy your day. Thank you very much.